it's Eric with Jazz Wealth Managers. Today we're going to talk about it's Mr. Steal Your Money. That was embarrassing. So what that comes to is a couple of representatives are coming after some money. There's a new tax law that is being proposed that's going to come after anybody that's a high income earner. So what I mean by high income earner, maybe it's you, maybe it's not, maybe you're happy to hear this. But the idea would be that if you have $250,000 or more in earned income, then they are going to make you pay Social Security tax. Currently, let me show you exactly how it works right this second. So this is actually the bill I'll show you in just a minute. But if we're looking here at our contribution rates, so 2022, let me try to zoom in for you on this, see if we can get that a little bigger, and hopefully you can see that. So in 2022, it was $147,000. So the way Social Security works is when you're making $147,000, if you're making that, you're going to have to pay 6.2% to the government for Social Security, and the employer is going to also pay 6.2%. The total is going to be 12.4%. The new proposed bill by, is this DeFazio and Bernie Sanders is going to say that the legislation would lift the income tax cap from $147,000 and subject all income above $250,000 to the Social Security payroll tax. Under this bill, more than 93% of households would not see their taxes go up by 1 penny. Well, and that's nice. I mean, that's good to know. I think that there's always the argument on at what point are people that are making a lot of money paying too much in because they're never going to see the benefit. And when I say that, this is what I want to show you. Now, everybody has their views on this, but let me just kind of break this down a bit to give you an idea of exactly how this looks. It may make you happy, it may make you sad, it may make you angry, but hey, my job is to give you the facts, and that's what I'm going to do. So let me step over to the handy-dandy board, and what I want to break down right this second is let's just say that you make $250,000. Now that $250,000, we're just going to leave it in a flat, linear fashion. We're not going to try to get any crazy with inflation and stuff. But if you were to pay 6.2% in, and your employer were to pay 6.2% in, that's going to be $31,000 annually that is being paid in to Social Security. Now, if you were to invest that money, let's just say that this was a 401k instead, and you were to put that money in, they were to match it, you got the $31,000, and you made a 7% return, hypothetical return there. You know, I'll give all the disclosures, nothing's ever guaranteed, blah, blah, blah. But when it comes down to it, if you were to work for 30 years, which is what the Social Security takes into account, 30 full years of working history. So if you were to work 30 years and contribute this amount, your total at retirement would be $3,133,264. Now, I can promise you one thing, because the thing about it is that when we are looking at everything with Social Security, the government doesn't set it up like a regular pension, because a lot of pensions actually allow you the opportunity to cash out. You can say, you know what, I can do better with this money, or I want to make sure that I have it for inheritance for my children, or whatever the case is. You may cash out of the pension, you may take the lump sum and then invest it. We have seen that quite a bit. With Social Security, you don't have that option. Instead, you're paying all this money in, and regardless of what ends up happening, you could die at 62, that money is gone. The government keeps every penny of it, and you can bet yourself that they're investing that money to make money on top of it. Now, I understand there's the idea that, we've got to keep, Social Security going, and that is what DeFazio and Sanders are talking about here, because they're saying that it's going to extend the solvency of Social Security Trust Fund for 75 years through 2096. Now, maybe you feel that it is something that this is going to be a benefit because you're not making the $250,000 and you really don't care. Or maybe you're making $250,000 or more and you're saying, well, hold on a second. That's a lot of money that I'm paying in, and I'm never going to get that full amount. Because that's the one challenge when it comes to these bills, because what you've got to look at is what's truly fair for all. Now, I'm giving you just the numbers. There's a lot of debate that can happen. I'm happy to hear it in the comments. I'd actually like to hear what you think. Thanks for watching. If you want to watch more FinTips videos, click here. Be sure to like and subscribe also.